assumptions currently reflected in the plan. The RIIO-T3 framework includes major transmission projects such as Eastern Green Link 1 and 4, as well as Western Link 2, as Nicola, Keith, and the team will explain this afternoon. In the US, we're investing approximately 3 billion euros in regulated transmission assets. This includes 1 billion euros allocated to CMD transmission and nearly 700 million to UI transmission, both in Maine and Connecticut, both under FERC jurisdiction. In New York, under the CLCPA, we call it now Power in New York, environmental protection legislation, our planned investment amounts to 1 billion euros, already approved. An additional 1 billion euros is allocated to contracted transmission projects, such as the NECC project in the US, a project which will be commissioned before the year end, as well as some of the transmission projects we are developing and finishing right now in Brazil. All of them under construction and nearing completion. Something important is affordability. The investments outlined will play a key role in strengthening the electricity system and improving cost efficiency. By enabling the integration of additional demand, they contribute to a lower cost per megawatt hour, as the costs, which are mostly fixed, are diluted. Upgrading aging infrastructure and improving grid automation with AI and digital solutions are essential to creating smarter, more resilient networks. We are shifting from recurrent O&M costs to long-term investments, which are more sustainable. New investments are more cost-effective. This afternoon, you will be explained how in the UK, for example, an estimated approximately £6 billion per year of system constraint costs can be avoided in the decade. This transition also supports the adoption of more energy efficiency solutions across transportation, buildings, and industry. New demand drivers, such as data centers and AI, are changing the traditional usage patterns, which steady 24/7 electricity needs make electrification the only viable path forward. This creates a positive cycle in which improved infrastructure supports demand growth, reduces system costs, and enhances efficiency, ultimately reinforcing long-term affordability. Now turning to power and customers, we're taking a very conservative approach. In addition to the significant investment needs driven by aging infrastructure, new electricity uses, such as data center, transportation, and industrial electrification, are now the main drivers of demand growth. On the demand side, we expect an increase in electricity consumption across our distribution areas, plus more than 2% in the UK, around 2.3% in Brazil, and more than 2% in Spain, are slightly below national system forecasts. Retail customer demand is projected to remain stable. Regarding pricing, our assumptions are aligned with forward market levels, which represent a normalization in price levels around 60 to 65 euros per megawatt hour in Spain and approximately 75 pounds in the UK. Looking at the main drivers in the power business by country, in the UK, we are progressing with the construction of East of Anglia 3 and East of Anglia 2 with expected COD in 26 and 28. Additionally, our offshore pipeline provides potential opportunity for future growth, only on a very opportunistic basis. In the US, we are only considering the commissioning of projects under construction. Vineyard Wind 1 construction is on track with more than 50% of the turbines already in operation and will be fully commissioned in the upcoming months. In Brazil, we are considering no capacity additions in the short term. In Spain, we're assuming the nuclear phase-out is scheduled in line with the current protocol preparing for the closure of Almaraz 1 in November 27 and Almaraz 2 in October 28. In other regions, our priority includes Australia, where we are focusing on new storage capacity, Germany, with the completion of the Windanker offshore wind project, and Italy, where we're expanding and increasing our solar photovoltaic capacity. These assumptions, along with a highly opportunistic investment approach, guide our 21 billion euros investment plan in power and customers. Within this plan, all projects have already been identified, with 75% of them already under construction. Of these 21 billion, approximately 8 billion euros is allocated to the completion of offshore wind projects that are already under construction. Onshore wind projects follow with 5 billion in planned investments. Additionally, 2 billion are also for storage, including battery systems and pump hydro facilities. This investment will deliver 9.5 gigas of new capacity in the 4-year period. 75%, as I said, already under construction. At the same time, 75% of the new capacity will be sold either under regulated schemes such as contracts for differences or under long-term power purchase agreements with Tier 1 customers. Iberdrola's current installed capacity stands at 56,800 megawatts, which is expected to increase by 4,000 megawatts, reaching nearly 61,000 megawatts, which out of them 90% emissions-free by 28. While we will be adding close to 9.5 gigawatt of net growth, is largely offset by the sale of assets in Mexico, asset rotation, and the close of the 2 nuclear facilities in Spain that we just mentioned. Going into detail, in offshore wind, we currently have 4 projects under construction, totaling 3.5 gigawatts. We expect to complete the commissioning of Vineyard Wind 1 by the end of the year, while Windanker and East of Anglia 3 will be expected to be commissioned in 26, and East of Anglia 2 will be commissioned in 28. Our participation in future offshore auctions will continue to be limited to regulated frameworks that offer adequate returns with risk minimized through secure supply chains and route to market. In onshore wind, we plan to install 1.9 gigas of new capacity, 90% of which is already under construction. This includes repowering projects in the US, in Spain and the UK, such as the 50 megawatts repowering of Molar del Molinar in Spain and 98 megawatts of Lean Juniper in the US, as well as some landmark initiatives like the hybridization of our Tâmega hydro project in Portugal with a 274 megawatt onshore wind farm. The plan includes the installation of 2.2 gigas of solar power photovoltaic capacity, 70% of which is already under construction, including hybrid projects incorporating battery storage, such as the Broad Sound in Australia. We will also add 2 gigas of batteries over the period, with 0.5 gigas under construction like the aforementioned Broad Sound in Australia and 100 megawatts in Spain benefiting from public subsidies. The remaining 1.5 gigas will be mainly allocated in Australia and Spain. This will be executed with a highly opportunistic approach, supported by regulatory frameworks and customer contracts. Furthermore, we have several investments in the period allocated to pumped hydro storage projects to be commissioned after 28, with a pipeline of 3 gigas of pumped hydro storage in Iberia, in the Duero, Tajo Sil, and Júcar rivers that will provide future storage capacity beyond 28. The increasing penetration of renewables is creating both the need and the opportunity to invest in storage technologies, with potential across daily and seasonal arbitrage. Both technologies are essential to the system. However, long-duration energy storage offers superior performance compared to batteries. Pumped hydro is nearly 6 times more effective than 2-hour battery storage systems in terms of security of supply. It does not suffer from degradation, has a longer asset lifespan, and is 3 times more effective than 2-hour batteries in supporting decarbonization and the integration of renewables. As a result, we have a pipeline of more than 3 gigas of pumped hydro storage projects in existing dams in Iberia, where the margins are 10 times higher than 6 years ago, and where the load factor is expected to further increase in the coming years. On the other hand, batteries could also offer some advantages such as faster response to balancing market, lower development time, and smaller space requirements. Our plan also relies on the commissioning of 2 gigawatts of batteries, with a special focus on Australia. Moving into our route-to-market strategy, access to multiple sales channels is one of our key competitive advantages. It enables us to maximize asset profitability while limiting exposure to market volatility. New capacity additions expected over the next 4 years will contribute between 15 and 20 tera-hours to our current production available for sales, which stand at 105 teras. bringing it between 120 and 125 teras by 2028. Our production is sold through a diversified mix, with 21% sold to retail customers, 59% to industrial customers under power purchase agreements or other arrangements, and 20% under regulated contracts such as CFDs and feed-in tariffs. This approach ensures a stable and predictable revenue across all regions. In fact, 90% of our revenue for 26 and 75% for 28 is already secured, reflecting our strong contractual coverage and strategic positioning. In our customer business, we plan to invest 2.5 billion euros between 25 and 28, mainly to continue with a profitable business, to preserve our market share, and to secure long-term contracted revenues across all regions. In the retail segment, we serve more than 11 million customers in Spain and the UK, with an average of 3 contracts per customer. The majority are in Iberia, 80%, and the UK, 20%. While we expect no growth in this period in line with our conservative assumptions, our focus will be on cost to serve optimization, excellence, and digitalizations to enhance value and efficiency. In the industrial and commercial segment, strategic partnerships have enabled us to secure over 250 teras in contracted volumes through 2030. This reflects the strength of our commercial relationships and the trust placed in our energy solutions. We're also leading the way in the data center energy solutions, already supplying over 11 teras annually to top-tier customers in the US, 7 teras to Amazon, Google, Microsoft, Meta, etc., and the UK, 1 tera to Amazon. And in Europe, 3 teras to Amazon, Microsoft, Telefonica, Vodafone, etc. In Iberia, where demand from data centers is expected to exceed 10 teras by 2030, one of our flagship initiatives is a joint venture with Echelon, featuring a major data center project in South Madrid. This is an example of a single project data center creating an additional demand of 1 tera. 11 of such projects will represent approximately 5% of Spain's current electricity demand. We have 7 more projects in Spain with secure land and green connections, positioning us to meet demand with agility and scalability. Let's focus on efficiencies, as we always do, for the past 25 years. We're aiming to achieve 400 million euros in operating efficiencies over the gross margin ratio of 25.8 in 22, to bring that, to 25.4 in 24, and then to expect to bring it now below 25% by 28. This improvement will be driven by several initiatives across our core areas. In networks, we're increasing automation and resilience through technologies like ADMS, which enables real-time load balancing and outage response. Moreover, we are deploying AI-powered customer applications to reduce call certain volumes. In generation, repowering opportunities and hybrid solutions allow us to maximize the value of existing assets. For our customer business, we are enhancing our understanding of consumption patterns to deliver tailored and efficient solutions. We're also improving retail cost to serve and deploying a new scalable cloud-based technology platform powered by AI for our Iberian retail operations, designed to meet the challenges of an increasing competitive market. Our O&M processes benefit from the standardization of equipment and procedures. These processes are in continuous improvement with new tools for predictive maintenance based on data analytics and AI optimizing asset availability. For instance, the use of robotics and drones for lines and substations inspections is significantly reducing the need for manual site visits. Together, these initiatives reflect our commitment to leverage digitalization, automation, and data intelligence to drive sustainable value creation. I think in the workshops today, you will see many examples of them. Moving to supply chain, another key enabler of this plan is our robust supply chain strategy. Several months ago, we delivered a webinar containing all the details of our supply chain strategy. However, today, we will provide a brief overview. 80% of our strategic equipment needs through 28 are already secured, ensuring availability, schedule reliability, and price stability across our operations. This proactive approach allows us to minimize exposure to commodity price fluctuations, inflation, and foreign exchange risks. A key difference is our commitment to local manufacturing, especially in networks, with 95% of purchases being local. This not only supports regional economies, but also protects us from tariff impacts and supply chain disruptions. By leveraging global volume and standardization, we are achieving competitive pricing through economies of scale. For our big businesses and main businesses in networks, 95% of strategic equipment, AV, HVDC components, GIC, high voltage circuit breakers, cables, and distribution transformers are already secured, thanks to a combination of centralized and local procurement strategies. In power, for projects currently under construction, 100% of strategic equipment is already secured. In summary, our supply chain strategy is built on foresight, scalability, and localization, becoming a cornerstone of our operational efficiency. In the afternoon, you will have further details and insights. Let's go now to the regions, to our geographies. Let's start, as the chairman pointed out, as you have seen throughout the presentation, we're operating in the right countries. These countries are where we have personnel with the right skills, where governments have shown a strong commitment, and where we personally oversee operations to ensure successful execution of our investment plan. Let's go one by one. The United Kingdom, we intend to invest in our plan around 20 billion euros between 25 and 28, with 14 billion euros allocated to our network business. This investment will result in an increase of over 9.5 billion euros, which is 70% growth, in our regulated asset base, rising from 15 billion to reach 24.5 billion by 28. Of the 14 billion, approximately 8 billion will go to transmission and 6 billion to distribution. In power and customers, 6 billion euros will support the construction of offshore projects, both East of Anglia 3 and 2, as well as 300 megawatts of onshore under construction. The current installed capacity of 3,000 megawatts will increase by 2,000 megawatts, approximately 70%, reaching 5,000 by 28. On the retail side, we remain focused on promoting electrification through smart solutions and strengthening customer loyalty. In the US, our investment plan totals 16 billion euros over the period, with 12 billion euros directed to networks, 70%. This investment will result in an increase of over 7 billion euros, which is 60% growth in our regulated asset base, rising from 14 billion in 24 to 21 billion by 28. In transmission, alongside regulated projects, we are completing, as I mentioned before, an ECC project. In power, we are focused on commissioning Vineyard Wind 1, repowering onshore projects, and building new ones, all benefiting from the existing, and the previous tax credit mechanisms. The current installed capacity of, 10,500 megawatts will increase by, 1,500, reaching 1,200 megawatts installed capacity by 28. In Brazil, we plan to invest 5 billion euros in organic growth, with another 2 billion euros in the acquisition of the previous stake in Neoenergia. 90% of this investment will result in an increase over 2 billion euros, 20% growth in our regulated asset base, rising from 11 billion euros to 13 billion by 28. This will support the growing demand for electrification across jurisdictions. In Spain, the plan includes 9 billion euros investments between 25 and 28, with 4 billion directed to networks. This investment will result in an increase over 2.5 billion euros, 30% growth in our regulated asset base, rising from 9 billion to 11.5 billion by 28. As explained before, this is contingent to the regulatory framework that should ensure sufficient returns and increases the investment limit and guaranteed OpEx recovery. Our geographical diversification minimizes whatever the outcome may be. In power and customers, investment will reach 5 billion euros with 60% in generation. The current installed capacity in Spain stands at 31,800 megawatts and will increase by 500 megawatts, reaching 32,500 megawatts. We'll be adding around 2,000 megawatts of which 600 will be batteries. However, the net growth in renewables is offset by the closure of Almaraz. In retail, investment will be focused on maintaining market share in a more competitive environment and supporting electrification through EV solutions and industrial decarbonization. Australia and other European countries is what we call our Iberdrola Energía Internacional. We plan to invest 5 billion euros, mainly in Australia, Germany, and Italy. This includes more than 2,800 megawatts, featuring the completion of the 315 megawatt Windanker offshore project in Germany, 1,200 megawatts of a storage project in Australia, and 600 megawatts of solar PV in Italy. These investments will increase the current installed capacity of 4,300 megawatts to over 7 gigas by the end of 28, representing a 60% growth over the period. Moving to evolution of the business in terms of EBITDA, in summary, our investment plan is not only ambitious but also transformative. By 28, we expect to reach an EBITDA of 18 billion euros, an increase of 3 billion euros compared to 24, driven primarily by growth in our network business. This segment will represent 55% of the total EBITDA, 40% up from 24, clearly reflecting our strategic pivot towards regulated income and long-term value creation. In terms of country, geographically, the shift is equally significantly. The US and the UK will jointly contribute 50% of our EBITDA by 28, compared to 37 in 24. These figures underscore our commitment to focusing on high-growth, high-return markets. To conclude, this 58 billion plan reflects a disciplined approach to capital allocation, focused on stable, high-return markets, and supported by strong regulatory visibility. Thank you very much, to all of you, and we're confident that the team will deliver to the chairman all of you this plan. Thank you.
Okay, following the agenda, we are going to have now a coffee break. Just here. It's a question of 15 to 20 minutes. Thank you. Following with the set of presentation, it's a pleasure to give the floor to Mr. Pepe Sainz.
Hello, good morning to everybody. Before I start, I have a special announcement for analysts and investors, because my IR team is very worried because apparently our EBITDA is slightly below the numbers that you have, no? And they have asked me to explain you a couple of reasons of why this is the case. I hear that you were kind of expecting around 19 billion, and we are giving you 18 billion. Actually, it's a little bit higher than 18 billion. It's closer to 18.5 than to 18 billion. But in addition to that, they have asked me to tell you first, we are not including, obviously, Mexico, which is 600 million, because we are going to sell it. We are deconsolidating also East of Anglia 3, which was adding 300 million to the EBITDA. And also, as we explained due to the capital allowance, our revenues in the UK are lower, so this is another 300 million. So if you add these three things, then would be above the 19 billion. But in addition to that, and this is something that I have been thinking during these 10 minutes, is first, we have 500 million less of EBITDA due to the devaluation of the dollar and the real, which actually is much lower at the net profit level, because as you know, part of our cost is in interest cost is in these currencies. And second, take into account that we have been acquiring the minorities of Avangrid, and we are buying the stake of Previ, which adds to our net profit, but not to our EBITDA. So all in all, if you add all that things, probably would be an EBITDA of around 20 billion, which is not bad. Huh? Okay. So giving this announcement, let me start the presentation. And you know, after the chairman and the CEO convincing presentations, it is clear that Iberdrola has a unique business and financial model that combines predictability and profitable growth with a strong financial profile and a dividend policy that grows in line with our earnings. Our business model, that is based on regulated and long-term contracted business, being networks our key investment decision, while we continue to invest in renewables through a selective approach, securing long-term cash flows through CFDs, PPAs, and our retail position. We focus on air-rated countries, which generate over 90% of our operating profit, and it is supported by our centralized financial model that I will detail in this presentation, with a strong commitment to the BBB+ Baa1 rating, has provided in the last years a total shareholder return of 350% over the last 10 years, outperforming the market and peers with a higher net profit growth with lower volatility. Despite this, Iberdrola trades at a lower PE ratio than other industry leaders and indexes, making us an attractive investment opportunity in an industry that, as the chairman has explained, will provide substantial growth in the future. As I have mentioned, and as you can see in the slide, Iberdrola has provided shareholders with a total return of 359% in the last 10 years, beating the global indexes such as the S&P 500 and the MSCI World Index, and almost tripling the utilities index. We have also outperformed other defensive sectors like luxury, healthcare, and staples that have higher multiples than us despite this worse performance and a more uncertain growth path than Iberdrola, as we are very well positioned in a global context in an industry of rising demand for electricity and grid infrastructure that offers an attractive future growth for an extended period of time. Iberdrola not only offers growth at an attractive multiple, but also more certain and predictable. As shown in the slide, Iberdrola net profit growth from 2019 to 2025 has clearly outperformed our major European integrated peers during a period of global uncertainty, with the COVID, with the Ukraine-Russia conflict, with new trade tariffs, with supply chain problems, and with less appetite for renewables. And we've passed all these different volatile period with very little volatility in our case. Our net profit standard deviation is close to zero, offering an attractive risk-return combination compared to others. Our 9% net profit cumulative annual growth over the last 10 years has also consistently outperformed global indexes. And our shareholder remuneration has been fully aligned with our net profit and earnings per share growth, providing strong visibility and consistency. Let me review quickly the 24-26 plan, which we are already over-delivering. Our first half 25 adjusted net profit grew 7%, excluding one-offs, fully in line with our mid to high single-digit target, but coming from a higher 24 close that allow us to predict a higher net profit for 26 that was forecasted in our Capital Markets Day below what we are going to provide. In terms of financial strength, our FFO over net debt ratio increased to 24%, comfortably aligned with the BBB+ Baa1 rating that agencies requires. Regarding asset rotation, our 12.2 billion target has been exceeded in terms of volume, timing, and profitability, supporting the group's strategic reorientation towards networks as this partnership and asset rotation has made possible the acquisition of ENW, the Avangrid minorities, and the previous stake in Brazil. And on the sustainability side, the most critical metric for contributing to the energy transition, emissions intensity reduction, it has improved by 21%, from 83 to 65 grams of CO2 per kilowatt hour produced, even before the last thermal divestment, which will further reduce emissions to close to zero. Regarding our 25-28 plan, first, let me point out that it is mostly funded. We have taken the necessary steps to finance this ambitious investment plan. We have successfully executed our 5 billion capital increase, which takes away any need for additional equity at least until the end of the decade. And this is a special announcement for bankers. We are not going to issue more equity at least until the end of the decade. Our asset rotation and partnership activity has been extraordinary. 75% of our current target for the 25-28 period is already completed, and up to 90% is advanced at an attractive PE multiples. Iberdrola will continue to fund the investment needs through stable and predictable cash flow generation and its diversified sources of debt financing. During this period, we will need to fund approximately 83 billion. CapEx will represent 72% of our total needs, including 2 billion for the ENW debt. 58 billion will be the group investments, including 5 billion of work in process. Shareholder remuneration and minority interest will account for around 24% or 20 billion, and the remaining 4% will be working capital, or around 3.3 billion, of which 1.4 billion is related to one offshore wind farm, OFTO, that will be recovered in 29, so half of this working capital will be recovered in 2029. As shown in the slide, 63% of our funding needs will be covered by our funds from operations, which will grow by 2.3 billion in the period, reaching 14.1 billion in 28. Asset rotation and partnerships will contribute around 16%, of which 90%, as I have mentioned, is already completed or in advanced stages. The remaining 6% comes from the already executed capital increase. As a result, our financial solvency will be strong, given the limited increase in financial debt, as it will be only 15% of our total sources. As I was mentioning, we have developed an extraordinary partnership model capable of attracting Tier 1 investors, allowing us to raise equity at an attractive PE multiples, making these transactions in general accretive for the company. Our current plan sets a 13.2 billion target for the 25-28 period, 7.6 billion from partnerships, 58%, 5.6 billion from asset rotation, 42%. As shown in the slide, 90% of this target is either completed or in advanced stages, assuming the successful closing of the latest Mexican transaction. As I mentioned previously, this has allowed to increase its exposure to the network business. The key macro hypotheses of the plan are aligned with the market forecasts. Compared to our previous plan, we estimate a slightly higher inflation, mitigated in the Eurozone by the euro appreciation and lower energy prices, a higher interest rate environment, which compared to the forecast we had in our previous plan, will reduce the net profit by 186 million, as short-term rates will be higher, except in the Eurozone, and long terms will be higher, driven by debt sustainability concerns and European reindustrialization. GDP growth is expected to be slightly lower due to the trade tensions, geopolitical risks, and macroeconomic uncertainty. On the foreign exchange side, a worse scenario compared to our previous plan has led to a 160 million reduction in 28, and, as I mentioned, an over 500 million reduction in the EBITDA, 160 million in net profit. The US dollar is depreciated from 109 to 118 euros. The British pound is slightly appreciated due to the persistent inflation and favorable rate differential. And the Brazil real, the real is depreciated due to the concerns over higher fiscal deficit from 5.63 euros to 6.45. You can find the detailed macro hypothesis set and its comparison to the previous CMD plan in the annex. When it comes to value creation, our plan prioritizes, as the chairman has pointed out, regulated and long-term contracted business in A-rated countries with favorable regulatory environments. This strategic focus ensures attractive and predictable returns across the group. In our network business, investments are aligned with well-established regulatory frameworks, securing an average return on equity of 9.5%, nominal post-tax, which is consistent with an average IRR of over 8%, and an EBITDA over CapEx ratio of 10% or above. In power, renewables, and customers, our selective investment approach with CFDs, PPAs, and retail positions covering around 85% of the expected production, allow us to achieve an IRR range of 7 to 12% and a spread to WACC of more than 200 basis points, depending on the cost of equity assigned to the investments and the risks differs depending on the technologies and markets. As a result, we expect the group CapEx will generate a spread to WACC over 200 basis points on average, with a low risk profile. Iberdrola, as I mentioned, will maintain a solid credit ratios throughout the 25-28 plan, reinforcing its commitment to the current credit rating. The evolution of our financial ratios reflects the progressive transformation of our business model. Iberdrola is transitioning towards regulated networks by 28. 55% of our EBITDA will come from regulated activities. If we include long-term contracted business, this share increases even further, bringing us closer to the profile of regulated company that, as you know, rating agencies demand lower ratios. Our estimated ratios for 28 are leverage increasing moderately from 45.4 to 47% in 28, FFO over net debt of around 22%, and retained cash flow over net debt close to 19%. Although our internal ratio calculations differ from those used by rating agencies, these levels are comfortably within the threshold required by them to maintain our current rating, as our business profile continues to improve due to our increasing exposure to A-rated countries and the growing weight of regulated and long-term contracted business. The evolution of Iberdrola net debt and its interest rate and currency structure reflects its commitment to maintaining a prudent financial profile. From 52 billion in 24, net debt is expected to reach around 55 billion in 26, an increase of only 3 billion over 2 years, despite higher investment. And this is thanks to the fact that we had made the capital increase and the asset rotation and partnerships that have been made upfront. From 26 to 28, net debt will reach around 64 billion, because we will basically, the plan has been funded in advance. Our debt structure will remain prudent, with 73% of the total debt at fixed rates, covering more than 68% of the fixed EBITDA. In the US, we will have around 88% of our debt fixed, aligned with the regulatory frameworks. The majority of our renewable assets also are under fixed price schemes, such as PPAs. In the euro area, or in the euro, around 72% of the debt is fixed, reflecting the higher share of liberalized business in the EBITDA. Within the British pound, our income is balanced across fixed, floating, and inflation index components. So we have around 58% of our debt fixed. And in Brazil, our debt is inflation indexed, as it is our EBITDA. Regarding the currency structure, we follow a natural hedging policy, financing the group in the same currency as our FFO. For the first time, the euro-denominated debt falls below 40%. The remaining 60% is in other currencies, with the pound and the dollar having a higher share. We will reduce our Brazilian exposure by 4 percentage points in 28 as we finish our transmission investments. Our cost of net debt is expected to decline throughout the plan, reaching 4.4% by 28, down from 4.8% in 24. Excluding Brazil, the cost would be around 3.6%, compared to 3.7% in 24. The average debt balance in Brazilian reals will decrease from 13% in 24 to 9% in 28. This, together with the devaluation of the real and the dollar versus the euro contributes to overall improvement in the group's cost of debt. Nevertheless, we are facing higher interest rates compared to the Capital Markets Day of 24, where the 26 net financial cost expected was 4.4% below the 4.8% in this plan. The higher rates are expected to reduce 28 estimated net profit by approximately 186 million compared to our expectations in the last Capital Markets Day. Regarding hybrids, Iberdrola remains confident and committed to its current hybrid portfolio, which will be maintained at euros 8.25 billion throughout the plan. Our hybrid strategy continues to support our credit ratings. During this plan, our focus will be on refinancing the outstanding hybrid stock. We expect investor demand for our hybrids to remain strong, driving lower spreads. We will maintain moderate financial needs, as I was mentioning, throughout the plan. Around 32 billion, 20 billion will be refinancing maturities, along with 12 billion of additional debt. Around 6 billion of new needs are already signed, making even more comfortable our maturity profile, as you can see. Our financial needs will be covered according to our centralized financial model, financing from the holding up to 72% of the total, except for regulated companies in the US and Brazil. US will take around 20%, around Brazil 8%. By product, we will cover our needs mainly through the bond market. One thing that I have to mention is that we will try to do as much as we can in the US market, which is a market, the largest market in bonds that we have not tapped in the last year. So there is a huge possibility of issuing in this market, and we haven't tapped it because up to now has been more expensive than the euro market. The rest mainly will be covered through multilaterals, export agencies, and development bank loans that have more and more possibility of having loans from them because they are increasing their financing targets. And this is a very interesting market because it's not subject to the capital market volatility, provides financing at very competitive prices. Bank loans will be only around 10%, a low level, that allow us to maintain non-use capacity for other products like credit lines, derivatives, letters of credits, etc.